This is another FFCCU blog quick tip.
We've talked about home equity loans before, but as a simplified refresher, a home equity loan, or HELOAN, is a lump sum of money you can borrow from using the value of your home. If you're applying for a HELOAN, here are a few terms that you might hear. An amortization schedule spells out how much you will pay over the life of your fixed-rate home equity loan. It specifies what amount goes towards interest versus principal. It typically curves over time, with a greater amount going towards the principal in the later life of the HELOAN. Debt-to-income ratio. This is determined by taking all of your monthly debts, including your new HELOAN, and dividing by your monthly gross income. This percentage is a benchmark that lenders will use to decide if a borrower appears capable of reasonably paying on their new loan. Typically, your DTI needs to be under 40% for strong approval chances, but this can vary by lender. Tune in on YouTube and social media channels for part 2.